Excellent. Thank you, Rolly. And hello, everyone. Hope everyone's having a great day so far. I just want to give a big thank you, first of all, to everyone at Trading Pub and NinjaTrader and Shark Indicators for sponsoring the event, namely Rolly and Yana and Wesley and Sean. Now, we've already heard from some outstanding presenters so far, Raul from iSender, Richard from High Percent Trading, both with their own very unique style of trading. All right, what I'm about to be showing you is also quite unique, but you may find it a little bit difficult to follow along with me as these are pretty advanced methods we'll be covering. So do try to pay as close attention as you can. And if you have any, a couple of questions along the way, I'll take at the end of each section. So if you're having a hard time following along, just put a couple of questions as they come up, and I'll check back at those periodically. Now, we only have about an hour today, and it will take me at least that just to begin to explain the concepts and tools properly. So, I really don't want to melt anyone's brain today. So we'll be having a part two to this on Sunday evening. All right, where you'll be able to, have a little bit more interaction with me, more in depth into some of the specific trade examples, and I'll be showing you exactly how you can use these methods to fine tune your own trading and really start to increase that profit factor. Okay, so what we'll be covering today are three of the most important methodologies for very consistent and profitable trading, namely multiple time frame analysis of volume or relative volume, which is incredibly more accurate, multiple time frame price and momentum and divergence analysis, and finally multiple time frame geometry analysis. Now, I understand that if you were somehow, a little bit newer to trading and technical analysis, monitoring multiple charts for each market can be incredibly intimidating. I understand that fully. Most of us really want something simple and easy to use, like red light, green light, mechanical systems, stuff like that. But unfortunately, from what I've, all the analysis and all of the testing and building systems that I've done over the past 8 years, that stuff just doesn't work very well. Okay, now, like I said, I've been building mechanical systems for about 8 years, discretionary systems as well, which is what I'll be showing you today. But the thing is, you can over optimize mechanical systems that have several rules and indicators, and you can get good back tests, right? But oftentimes, once you start trading live in sim, or hopefully in sim, hopefully you're not trading them immediately with a live account, they tend to fall apart pretty quickly, right? The fact is, most mechanical systems simply do not make money, or at least they don't make very much money, no matter how much you might pay for them from somewhere. So if you really want to make high returns in the markets, then you need to learn how to do proper analysis to support your trading, and that's what I'm going to be going into today. So if you do not have a solid methodology to trade with, then you're really doomed from the start. People argue, what's more important? Is it your psychology? Is it your methodology? Is it your risk management? None of that matters if you don't have a good system to start with, if you don't have a good methodology. And I think that's obvious to anyone that's been trading for, any number of years. All right, so on to the disclaimer. Here it is. Trade the Plan has no financial interest in the outcome of your trades. Do not trade with money you cannot afford to lose, because if you do, you will lose it. I think most of us realize that fully by now. So, simulated performance results. Now, I'm going to go ahead and show you my track record that I've been building since March 1st of this year, and it is in sim. Okay, so let's go over that. And the reason it is in sim, and I'm not showing you any live results using this method, or these methods, this system of methods, is that I've been vetting this properly. Now, when Raleigh introduced me, he talked about how I was working at a fund in Ecuador. Through that development process at that fund, we had to go through, while we were testing systems, I was a part of a few different aspects of that company for a little while. I was a junior trader, like an assistant. I would do charts and fill out the reports at the end of the day. It's just stupid stuff for the main trader, right? Stuff that busy work, basically. All right, but then I worked into developing systems with some of the older guys, and a lot of what they used was market geometry, and they actually did pretty well. When the bust happened in 2008 and 9, the last few of us that were hired were the first ones to go, right? Last in, first out. So that big setback, obviously, a lot of people lost their jobs, and I ended up moving back to Florida. But anyhow, to make a long story short, through that process, it solidified what is absolutely necessary in vetting a trading system for me. Okay, you don't just buy a system from some vendor and then start trading it live, hoping for the best. That's like shooting from the hip. You may as well be flipping a coin and just taking random trades, because every trade that you're taking is random anyway. All right, so what I've been doing since March 1st is I've combined all of these tools, and to be frank with you, the only reason I'm selling them is to help support the cost involved in developing them. Okay, and I probably won't be selling them for any longer than another six or 8 months or so. But over the past several years, I've been developing these tools, and it's an incredibly expensive and time-consuming process. But in combining all of these different methods, I started sim trading once everything was done on March 1st. So you see here, March 1st, sim trading up until today. And I'm doing both swing and day trading. But the fact is, there are only about 6, I think 7 as of about a week ago, 7 swing trades. So the majority of these trades are day trades. They're opened, sometime pre-market or during the day session, and then closed before the end of the day. So we're going to run this. You can see I've got sim selected, CQG, and these are the several markets that I've traded. Now, when I generate this, look at the size of this profit factor. All right, what I'm doing, combining multiple time frame geometry, relative volume, and divergence, is unlike anything that I've ever seen up to this point. No automated system that you'll develop, I don't care who you are, what you've developed, it'll never have a profit factor that large. All right, and it'll never have a ratio of your average winning trade divided by your average losing trade of anything near 3.2. Okay, this is really unheard of. So I did have one really bad drawdown. That all occurred on one day, and I was, by the end of the day, I'd made all of that back. I took a series of losses. NinjaTrader froze on me, and of course, your stop orders in sim aren't sitting on the exchange. So when I got everything back up, finally, it had blown way through my stops. But anyhow, I managed to recover that day, and you'll see from the graphs, I mean, that's just an incredible growth curve. But let's go to the daily net profit. That losing day was somewhere in here, and I managed to get back to just, I think it was that day right there, actually. Managed to get back to just a little bit over break even. Now, several of these days did start out as losers, but then managed to get back pretty quickly. During the first month, I was trading the full session. Excuse me, so from the morning until the close. And these 2 days were 2 swing trades in crude oil, the 2 big ones. None of these trades was over 3 contracts. In fact, I think it's about 60% are with 1 contract, 20% are with 2, and then another 20% are with 3. Okay, so I started off with a $10,000 account, trading it as such, and have just done incredibly well, better than I would have expected, really. And after about April, I started trading only 2 hours a day. This was a swing trade, this was a swing trade, and so was this. Okay, all these other were day trades. On average, when I'm trading, I may take on average between 2 and 5 trades. Okay, but I'm not trading every single day. For one thing, I've been developing the software, getting ready for presentations and all of that, so I'm not trading every single day. But let's go back to the summary. So including all of the days that I am trading, I'm sorry, all the days. Let's see, where is the average number of trades? So 2.59. Actually, that's just the number of days that I am trading. So on average, about 2.5 trades. Okay. And that's really key. When you have a small account and you're trading as we are, as retail traders, if you're taking 10, 15, 20 trades, there's no way that it's going to be easy for you to make money with the amount of money that you're having to spend just on doing business. Okay. We weren't allowed for different systems, we weren't allowed to trade any more than 15 trades. For most systems, we weren't allowed to trade any more than 5 per day for any one system. Okay, so if you're trading more than 5 to 15 trades per day, it's going to be very, very hard for you to even prove that you have an edge, for one thing, because having an edge means that you know beyond the shadow of a doubt that what you were doing is giving you a probabilistic edge over one thing. Essentially, it's giving you confidence that more times than not, you are going to turn that trade into a winning trade. It's very hard to prove that. If you know anything about doing backtesting, if you're backtesting by hand, that's what we did. I would do backtesting by hand. Somebody would come along behind me every single time without fail. Between 10 and 15% of my results were wrong because I had missed about 10 or 15% of the losers. Your eye tends to pick out more winners than losers when you're doing manual backtesting. All right, but I'm getting off on a tangent. So let's actually just jump into this because I really have a lot to cover. I just wanted to show you that these methods are legit. Percent profitability is almost 70. Average trade size is 18 ticks in crude oil. That's unheard of. We were graded on anything over 2 is acceptable. Anything over 3 ticks per trade is exceptional. Okay, anything over 2 was acceptable. Anything over 3 was exceptional. This is over 18 ticks. So, maybe that'll change a little bit when I have live money on the line as my psychology comes into play. But this is trading the rules precisely according to trading plan, with just a couple of variations here and there. All right, so let's do this. Let's jump into it. This is one of the most sophisticated things that I've had programmed. And if any of you guys know anything at all about divergence analysis, does everybody understand what divergence even is? Let me just kind of explain that for a moment. This is a momentum indicator. Now, what I've done is I've applied it to a z-score. If any of you guys know anything about statistics, a z-score measures standard deviations. Okay, so we have in here something called the balanced momentum indicator, which is a little bit better than the true momentum. I won't get into the details of it. It'll just, boggle the mind. So rather than showing the scale over here and the actual momentum of the specific price of the instrument, we're showing the momentum above 0 and standard deviations above the mean, and below 0 and standard deviations below the mean. You can see that lower bounds right there is -2. If you can barely see that, +2 is the upper bounds. Okay, so we can load any indicator whatsoever into this indicator, into this divergence indicator. It's like a pattern recognition software. It's incredibly complex. It took about 7.5 months just to make the specifications, and programming took another 3 or 4 months. So what it's doing is it's measuring momentum relative to standard deviations above or below the mean. Here, we have very strong momentum. You can tell just by looking at the slope of that swing right there, right? So very strong momentum. We get up to 2 standard deviations. We pull back. As we go back up, we're doing so on decreasing momentum. Here, the slope is very strong. Here, the slope is very weak. Okay, so we have bearish divergence. Higher highs in price, lower highs in momentum. That's signaling to us that price is slowing down into that area. Okay, and when we get into the market geometry, you'll see that these areas are defined relative to previous. Okay, let me just say this for one moment. Supply and demand is a function of previous areas of supply and demand. It's not necessarily the same exact areas where previous supply and demand came into the market. That'll become more clear later on, but you'll see with the market geometry, future supply and demand is a function of previous areas, not the exact areas themselves. Okay, so this indicator not only works with any possible oscillator you could put into it, but the setups are drawn in real time as dashed trend lines, all right, signaling the potential for divergence. So we have the setup, then we have the trigger. The setup is in real time as dashed trend lines marked with dots. The triggers are drawn as arrows, and you'll see that more closely when I get into some live examples. Here was the setup. We had a setup there, a setup here, a setup here, and then the trigger occurred right there. Okay, and when the trigger occurs, then the trend line becomes solid. There's no back painting or repainting. If any of you have seen, I bought every divergence indicator that's out there for every single platform that there is, and none of them get it 100% correct. That's why I took the time to do this properly. For one thing, I was testing some things in Bloodhound. If you're not familiar with Bloodhound, I'll show you what that is later. It allows us to do modeling and testing of automated setups very quickly and easily, but I wanted to do that. Richard, I know the chart's too small. I'm going to show you some live examples here in a moment. But I wanted to test this out with different automated systems, but I had to do that correctly, right? So I couldn't rely on all the other divergence indicators out there because most of them don't work correctly. They backpaint, a lot of them repaint, a lot of them are marking areas that aren't truly divergence at all, and they're missing perfect areas of divergence where we should be having divergence signals. So what else this thing has is it has a built-in swing trend indicator. Okay, and that'll become more clear what that is in a moment when I get into the details. As I said before, the built-in z-score indicator not only puts everything into standard deviations, but it helps to normalize the scale for every single oscillator that you bring in. If you're not, you don't have to use the z-score. You can turn it on or off. But if you're using it, you don't have to change the scaling for each indicator and instrument that you're using. Robert's asking, does it apply just type 1 or type 2 as well? Okay, so type 1 would be regular divergence, as you're seeing here. Type 2 is being programmed right now. It's supposed to be ready by August 13th, and that'll be included as a free update. Okay, we had to get the algorithms working flawlessly before we wanted to move on to the reverse or the hidden divergence or the type 2 divergence. So this would be a type 2 divergence between these two swings. Lower high in price, but a higher high in the oscillator. Okay, that will be built in along with email alerts and about 4 or 5 different filters, which I won't bore you with all the details now. It'll just kind of, gloss over everybody's eyes. But like I said, that'll be ready on August 13th. Okay, so now it is capable of being read in Bloodhound and or a strategy, and there are I think about 20 different videos right now. Not quite 20, I've got to upload several more showing you how to use it because it is pretty complex software and how to program that into Bloodhound and into strategies as well. Okay, so here are some different examples. Now, it comes with 8 different custom oscillators. Okay, so it can work with any NinjaTrader system oscillator, any of the 8 that come with it. And then if you have a third-party oscillator that you're using that you purchased from somewhere, you can use it with that as well. And I'll show you how to do that when I get into some live examples. So this is a 310 oscillator that comes with it. This is the Awesome oscillator, which is pretty similar to a MACD, just different settings and using exponential moving averages rather than SMAs. This is the balanced momentum. This is the one that comes default. This is the main one that I use for minute charts. This is the Chaikin oscillator. This is built from volume, and this is what I use for tick charts. This is a derivative oscillator developed by Constance Brown. I can't remember which book she has, Professional Technical Analysis or something, where she gives the details of the code for this. So we built that out, and that's available as well with the indicator, with the Divergences Pro. This is the DTI, the Directional Trend Index. I believe it was, I want to say William Blau. I should know that. I think it's William Blau that developed this. This is a pretty interesting indicator, similar to the SMI. Here's a double smooth stochastics. This is the SMI. Very interesting indicator. This is the gapless RSI. So if you're using, if you're trading stocks, let's say you're trading a 30-minute or a 60-minute using stocks, and you want to avoid that gap skewing your oscillator, this is perfect for you because it eliminates the gap completely. Okay, now this is the Divergences Pro input, the MACD difference. Okay, so let me show you how to do this real quick. Let's end the slideshow, and I'll show you how to build that one really quickly here. Well, let's just build it out. Let me just add the other one. This is the Divergences Pro right here. Now, rather than building in all of the different oscillators, which would make this thing incredibly heavy and slow, we've figured out a way to simply type in the name of the oscillator right here. So I have a cheat sheet, a PDF where you can copy and paste all the different oscillators I have. I think there's like 27 different oscillators built into NinjaTrader, plus my 8, and whichever other third-party oscillators you have, you just type the name. Of course, you have so many different options here to be able to control the look to these signals, and you can build a divergence from any of the different plots. You can build them from an average of the plots. Very complex. I won't bore you with all the details, but let's load a different oscillator now. Let's say the MACD histogram. So we have the Divergences Pro and the Divergences Pro input series, and both of those come together with all of the different oscillators here. But if you have a third-party oscillator, then you want to load that in through the input series here. KW is asking, which was used to generate the profit factor of 7.39? I use the balanced momentum on the minute charts and the Chaikin oscillator on the tick charts. So I'm using the Divergences Pro, the regular one, because I can type the names out directly into the indicator. Both of these are the same. Okay, the only difference is if you're using a third-party oscillator, that means the source code is locked. So when it's locked, we don't have access to be able to load it in the way that we've coded in the first indicator. I know this is a little bit confusing, but bear with me. If it's a locked third-party DLL, you need to load it into the input series here. Okay, TJ's asking why Chaikin on tick, because it's built from volume, and volume is pretty, I'm pretty big on volume analysis, and it just has a really nice look on the tick charts, and it's a little bit more responsive when you have a big move in volume as opposed to, very slight movement in price. Okay, I'll get into the details of that on Sunday. But let's load just something random. Let's use the MACD histogram. The difference, as NinjaTrader calls it. So we go OK and OK. And now it will load through the input series any other oscillator that I've loaded here, you see? And I can change the look of this. I can, make it look like a true histogram with the bars, etc., all of that. Let's just go through a couple of live examples here. Up top, we have the stochastics, okay? Here, we have the balanced momentum. This is the default indicator. I'm also showing the swing trend indicator, which is identifying the higher highs, lower lows, lower highs. That's built into the oscillator to identify the different swing points. This is a 377 tick using the Chaikin oscillator. You can see it's very good at finding these perfect divergence signals. And it does that in real time, and it's not back painting. Okay, you can control the size of the trigger. If you want this thing to trigger immediately, then you just change the settings up here, the deviation multiple, which different type of trigger you want to use. You want to use a weak thrust bar, strong thrust bar, oscillator turn, whatever. You just adjust it there. Okay, I'm spending an awful lot of time on this indicator. I don't want to overdo it. What do you say we move on to the floating toolbar? This thing is really, truly awesome. This is probably one of the biggest achievements in NinjaTrader programming that I've seen so far, and it's really only possible in NinjaTrader because of the the language and how they give us access to really everything. So I don't believe this could be even done for any other platform. All right, it's one toolbar to draw on any NinjaTrader chart or workspace. Now this is totally unheard of. Essentially what it's doing, it's acting like an indicator without loading an indicator onto the chart. It's always on top. You drag it anywhere you want. You click on the tool you want to use, whether that be any of the advanced built-in market geometry stuff, which I'll show you in a moment, or the standard NinjaTrader drawing tools. All right. You can delete individual fib lines with a click of a mouse rather than having to open it up and delete each individual line. This is perfect if you know anything about doing fib confluence work. It's essentially like turning the NinjaTrader platform into the Dynamic Trader platform. If you guys are familiar with that, Dynamic Trader was specifically built for doing market geometry, Elliott wave, and fib confluence work. So this is like taking those ideas, bringing them into NinjaTrader. This is what's so awesome about it, though. Okay, we have semi-automated trend channels, which update in real time as price moves higher or lower through the channels. If it's broken, it leaves a shadow line. You see the trend channel line right here was broken, and then it throws a shadow line. And you can hear the alerts going off in the background if you can hear that. We also have built-in alerts for every single line, okay? But it draws these semi-automated trend channels together with the median lines, which are the pitchforks, and or together with the ABCD projection lines, which is this line right here, okay? And like I said, it has sound and email alerts, and you don't have to set up the email server in NinjaTrader. It's all done automatically. You just put in your email. If you're trading, doing swing trading on much larger charts, you want to be notified when an area has been hit. When that area is touched or within a certain range, it'll fire off a signal, send you an email alert. You can then go to your computer. If you have a day job or whatever, you can go to your computer, decide if you want to take that next setup or not. Okay, let's do this. We'll go through the volume because this is probably the most complex thing to understand. All right, so I'm going to go through the volume, and then we'll go through a couple of examples on some live charts. Maybe I'll come back to the volume divergence analysis, but we'll get more heavily into that on Sunday. I don't want to. I realize this stuff is pretty difficult, guys. If you're brand new to this, your head is probably already spinning, but this is true analysis. This is really what it's all about. If you want to make, big money, you don't want to have a break even or 1.1, 1.2 profit factor. You want to actually make money in the markets. These are very important types of methodologies. All right, Tilt is asking, back on your momentum oscillator charts, does the software automatically draw the divergence lines? Yes, it does. It draws both on the price panel and on the indicator panel, which is something that wasn't possible previously in Ninja. So it's somewhat unsupported code, but it works flawlessly. Now we're going to get into the difficult stuff. Okay, if you thought what you've seen so far is difficult, this is where it gets a little bit convoluted. Let's say complex. Okay, so the importance and complexity of volume analysis. Most of us understand that volume is important. After all, it does govern the movement of prices, right? So here we can see, yes, so we're coming down. These volume spikes tend to coincide with the lows and certain highs in the market. So here we have another spike. Here we have another spike and a turning point. So most people understand that, yeah, it's important. You've got a lot of different theories out there, though, about how to use it properly. Some people say, oh, this is worthless. You need volume profile. Well, volume profiles are very useful. But as you'll see in a moment, when I get into the relative volume, that is incredibly useful. And you'll see that when I go through some of these examples. So here at the high, we've got another spike in volume. The problem is when you get into intraday analysis of volume, it becomes almost ridiculous to try to make any sense of this data that we see here. You've got incredibly high variance between the sessions. So this is obviously the day session and the ES. This is a 30-minute chart. You've got seasonality to the day session. You've got high volume in the morning, right at the open. You've got high volume near the close. And then you've got this kind of a lull or this saucer-shaped pattern here with low volume during the midday with the occasional spike here and there. Okay, so very low volume in the overnight, picks up in the European session, incredibly high at the open, lower during lunch, high again at the close. So how do you make sense of this? You can see it's even more pronounced on a 5-minute chart. Very low volume in the overnight, higher volume in the European session, very high at the open, very high at the close. We got this saucer shaped. So we've got the wide variance between the sessions and the seasonality of the day session. So how do we make sense of it? If we want to do some kind of volume spike analysis, we need to understand the standard deviation of the movement of volume. But when you have such a wide variance between the sessions and the seasonality in the day session, it's totally useless to be applying standard deviation bands to volume, especially on intraday data. On a daily chart, yeah, it's a little bit more useful. Daily and weekly, you can make sense of it. That's where volume spread analysis came in. It originated on daily and weekly charts, but using it intraday is another story altogether, okay? We can eliminate that overnight session, excuse me, altogether, be left with the RTH session, which is the regular trading hours, and get rid of that variance between the two, but we still have the seasonality. We still have the very high volume in the morning, the high volume at the close, and the low volume intraday. So even still, volume spike analysis or anything like that with standard deviation bands is still useless on intraday data because of the seasonality, even on the RTH charts. We could take it one step further and add volume per range. Now this would be taking the volume data divided by the width of the bars, the high minus the low, which is giving us what I like to call the density of the bars. It's let's put it like this. It's the amount of volume necessary to move the market every tick further. That's the volume per range. It's very, very important information. It's the amount of volume necessary to move the market every tick. Okay? So remember that. So why should we even learn volume analysis at all? It's obviously incredibly difficult. What's the point? Well, obviously supply and demand regulate the movements of prices. Everybody knows that. That's what makes a market. Auction market theory. You've got somebody selling, you've got someone buying, someone's either aggressively buying or aggressively selling, hitting the bid, hitting the ask. That's what creates a market. Finding the imbalances between the supply and demand is what actually causes the retracements, the reversals, the continuation patterns to happen. Okay, that's what governs the movement of the market. Identifying these imbalances in real time is what leads to big winning trades and high profit factors. Okay, you have to learn how to identify these areas. So a thorough understanding of volume analysis is what empowers great trading. You'll see a lot more about this on Sunday. All right, so why is it so difficult and convoluted? Just to recap, you've got the high variance between the overnight volume and the day session volume. You've got the seasonality during the day session. You got the higher volume after the open and just before the close. In order to actually understand it, you have to understand the relationship between the volume, the range, and the volatility. So there's a lot that goes into volume analysis. It can be quite difficult. Now, what's more, to truly make sense of it, it's got to be understood in the larger context of the previous market movements. And that's where the combination of the volume with the market geometry becomes so powerful. So how do I deal with this? What do I do? Well, I use the relative volume. And the idea actually came from Brett Steenbarger a number of years ago. He was actually using it to identify possible high volatility days. I've taken it one step further and applied, well, I'll show you. So this is the volume here. This is the volume per range. I'm combining both. What that relative volume is doing, let's say we're looking at this bar right here, this big blue bar. Let's say that bar occurs at noon. Okay, here's the volume of that bar at noon. Let's say it's 20,000, let's say it's 10,000 contracts on the ES on a 5-minute chart. What we're doing with the relative volume is we're taking that noon bar, that 12 o'clock, 12 p.m. bar, and we're comparing it with an average of the previous, let's say in this case, 15 or 20 days, 12 o'clock bars. So we're taking 12 o'clock bar this day, 12 o'clock bar that day, 12 o'clock bar this day, adding all that volume together to get an average, and then we're comparing today's 12 o'clock volume with that average 12 o'clock volume, and then throwing a percentage. So this bar right here was about 500% normal, so about 4 times the normal volume traded at noon every day. And you can see it was a big spike back up. Okay? So that's what we're doing with this. We're taking it one step further. Well, we're taking it 2 steps further. We're applying the volume per range, the relative volume per range, and volume spike analysis to give us different paint bar conditions and different volume spike conditions. Now here you can see we have an incredibly huge amount of volume. It's 1,200%, so 11 times normal at 5 a.m. and that's what stops this market. So that's incredibly high stopping volume. What we're doing with that, in order to get these, this is an extreme spike, the diamond, this is a major spike, that arrow, and this is a minor spike, that little X. How we're getting those is by combining all these different moving average envelopes, moving averages, the highest bar of the past 15 or 20 bars, standard deviation bands, combining all those in such a way as to get different sized spikes. So once it's above the 3rd standard deviation, it's the highest of the past 15 or 20 bars, we get an extreme spike in volume. So whereas this was the previous way that we would look at volume, which is, essentially worthless to us, now we have the relative volume, and we can see here we had an extreme spike, which ended that move. It was also a climax bar, which is signified by that blue bar. We turn back up. We have a major spike in the relative volume. It's also a churn bar. The churn bar, that yellow bar, means the highest relative volume per range. So we're dividing the relative volume output percentage, and we're dividing that by the range of the bar. And that tells us that the market is using more volume to move every tick higher than was previously necessary over the 15 or 20 past bars. Think about that for a moment. If the market is requiring more volume to move the market every tick further than was previously necessary, what does that mean? If we're coming into a high, let's say we're coming into a high here. All right. As we're coming into this high, we've got a little bit of volume here, a little bit of volume here, then all of a sudden a really big amount of volume and a very narrow range. What does that mean? That means that we had a bunch of market orders start to come in, buying market here, but the market's not moving anywhere. Why? Because you've got a lot of limit orders sitting right there, or you've got some sellers coming in selling market, So all of that buying, let's say you've got a buying climax going on, is being met with limit order selling, market order selling. You've got distribution right here. Yeah, right, Robert, the opposite of absorption. Well, it just depends on which way you're looking at it. You want to call this distribution, accumulation down here, whatever. That's what's causing the movement of prices. Now you can have, it gets a little complex here. You could have a move where you're going up and up and up, and essentially the buying dries up, and then you roll over. Or you can go up and up and up, and then you hit a massive amount of volume, and they start unloading it right there. Okay, so there's about 4 or 5 different reversal types. I'm just kind of showing you one right here. All right, so let's just go over a couple of more of these different signals. This is a minor spike right here on a weak climax bar. So we have a weak selling climax into the previous area of support. When we get these extreme spikes in the relative volume, it will throw off a signal. I'm sorry, it'll throw off a support or resistance line. At a high, it throws off a resistance line, which then acts as resistance for the future moves. And then at a low, it throws off a support line, which will then act as support until we break through it. And then here, it acts as resistance. Once it pulls back, it breaks through and pulls back. That's a weak churn bar, closing off the highs near the lows, showing that supply has just come back into the market there. Okay, I know this is complex, you guys. Does anybody have any questions about the relative volume before I move on? It is a little bit difficult to understand. I realize if this is brand new for you, but this gives us such an edge in finding the areas of support and resistance. It's really quite uncanny how this works. So it not only comes with, KW's asking, does it work with range bars? Not yet, but it will. Okay, I have a couple of different, well, I'll show you those in a moment, but the relative volume, the relative density, the relative range works on minute charts as of right now. I'm having it reprogrammed. Definitely for Ninja 8, everything will be finished. How does it relate to Wyckoff? It's like taking Wyckoff to the 10th degree. So we're taking Wyckoff, similar concepts of Wyckoff, and mixing that with a volume spread analysis. But we're doing that for intraday data and daily and weekly data. But we're doing it with relative volume. Okay, so we can get much, much more accurate on intraday data than you ever could possibly do with standard volume. So this is standard volume analysis, just to prove it to you, show it to you here. We got the very high volume here. So what does that volume spike mean to you? Absolutely nothing. What does this volume spike mean to you? Nothing. Just means it's very high volume at the open, very high volume at the close. When we put the relative volume on it, you can see that wasn't actually a very high open. That was an average open. We've got the average line right here. It's 100%. So it was actually below average for the open. Here, we've got we've got an extreme spike. It's both a climax and a churn bar, meaning that it's both a wide-ranging high volume bar and it's a very high volume per range bar as well. And that's mostly because we broke below these lows. So we ran some of those stops and the support came right back in, pushed it back up. We get a little doji there on another extreme climax spike, and then it starts to roll back over. Now, when you see one of these bars, let me just briefly touch on that. It's a climax bar, right? But you can see it's not a selling climax because we've just started selling. We've turned up here, come into a high, and then we get a climax bar. What does that mean? That's when you see that at the beginning of a move, that's like the kickoff to a new move. That's all of the selling volume rushing in, kicking off the new move. And when you pull back into that bar's range, you'll get resistance. Big boys coming in right here, selling this high, and they're going to keep adding to that short position as it pulls back in there. Work this thing down. When it gets down to an area suitable for an exit, then they'll start taking their position off. And that's the way the market works. It's right, it is similar to the better volume, Robert. I've taken similar conditions to the better volume indicator, but applied it to relative volume and then added the spike analysis, the volume spike analysis. So I've combined 5 or 6 different methods into one with the relative volume. Okay, and it's incredibly powerful. I mean, you can see that just by the results that I've had. All right, I've only got about 13 minutes, and I've got about 5 hours more for the for this presentation. So let's do this. Let's get past some of this. Okay, this is the relative density. This is what takes it to the 5th degree here. So not only do we have the relative volume, but now we have relative density, relative volume per range. I actually combine both of these, and I'll show you an example of that in a moment. I combine both of these together on the same panel. So relative volume and relative density. Relative density is taking the relativized volume per range. Okay, so that gives you even more thorough analysis of the churn bars. Remember, the churn is the high volume per range. That signifies either support or resistance coming into the market at an area. Okay, so that gives us a little bit more thorough understanding of what's going on. Some of the other conditions might miss an area where there's actually churn happening, high volume per range, and this helps us pick up on that. We also have relative range. Okay, we're taking the range. I don't know if any of you guys have studied wide-ranging bar analysis, but this would be like taking that wide-ranging bar analysis to another level. Okay. Since the relative volume only works on minute charts, I applied all of the same conditions, the volume spike analysis times the range, for minute charts and tick charts and range charts. Okay, so there's a different one for every chart type. This is the one for the tick charts, and you can see it actually, it rather than setting the bottom at 0, it sets it at, in this case, 150, so that you can see the difference in the size of the spikes. If I didn't include that algorithm in there, then it would all look like it's the same level up here, and you wouldn't be able to notice the differences between these volume spikes in here. Okay, you can see when you have a spike in the volume of the tick chart, that's usually showing you when somebody is exiting a position or entering a position, when a big player is entering a position or exiting a position. Here you've got one stepping in, putting on a big position, absorbing all of that selling. Then they're starting to unload it here at that major spike. They're starting to unload their position. When they start to unload their position, the market inevitably will start to retrace. He may come in and start supporting it right here, or a group of different traders may. And then when it starts coming up, then they start unloading up in here, and this helps you identify those areas. You also have the volume per second, which is built a little bit different kind of a way to avoid the extreme spikes. It doesn't allow a spike over 4 standard deviations. TJ, you could put it on a Renko chart, but let me just say this. Renko chart, price action, a lot of people would say that price action is random. It's not random, it's chaotic. But what is random is taking chaotic data, applying a false open to it and a false close to it. And that's what using Renko bars is doing. A Renko bar is taking chaotic data and making it 100% random. A lot of people don't realize that, but that's the truth of the matter. So, whatever that's worth. Anyway, you could use it on Renko charts if you like, but it's not going to give you very useful data because all of those reversal bars in the Renko will all be the same size, but then every bar in between, you have no idea how far price moved. Maybe it's 1 tick, maybe it's 5 ticks. You know what I mean? Better Renko is a little bit better. True Renko, the Chinese Renko. You're not seeing the wicks, so you really don't know how far it's coming back. I would say of all the different Renko types, the better Renko is the best because you're actually able to tell how far price has moved within the range of that bar. because you see the wicks and all that. But at any rate, this is volume divergence, all right? This is one type of reversal pattern. There are many types. Like I said, there are at least 5, okay? This is one type. When I think of volume divergence, I think of this right here. This is where I got fired. Right there's where I got fired in Ecuador. Sorry, Daniel, we've lost too much money. So when I think of volume divergence, that's it. You've got a very high amount of volume flooding the market, right? Then you get a pullback, and then when it comes back down to test that low or go through it a little bit, it does so on much less volume. You see that? Very high volume here, ton of selling, pulls back, comes back down to test it, but it's doing that on much less selling, signifying that the selling has started to dry up, right? Here, ton of selling coming in, pullback, comes back down, selling, but a lot less. You'll see these at strong areas for reversal. Now I programmed that in to Bloodhound. Here's a daily chart of the FDAX. I programmed that into Bloodhound. So Bloodhound sponsored this event, NinjaTrader Bloodhound Trading Pub. I programmed that volume divergence into Bloodhound, into the Bloodhound templates, but it's not a fully automated system, okay? It's just to show you when something is happening, and you only want to trade the volume divergence at an area. So here we're at the top of a channel. We're actually from high here to the high here, gives us the trend line. We pulled back to it. We've got the spike in volume right here. So a ton of buying into this high, but it's being met with resistance. We pull back, and then we go back up to test that high on less volume. And how do we end it? With a churn bar and then a buying climax in the relative volume. You see that? And that ends the move. These corrective patterns, it would behoove you to learn different types of corrective patterns. Okay, when you have these overlapping waves like this, you're typically, that's a dead giveaway that you're in a corrective move. And when you see a volume divergence signal at the end of a correction, chances are the next move is going to be hard and fast. And that's what I look for, these hard and fast moves. Here's another example on the ES 5-minute. Okay, we've got the high volume right here, very high. It's very high for a 5-minute. It's over almost 300%. And then we pull back. What do we end that move on? We end that move on a weak churn bar. And then it turns back up. We got the kickoff to the new move, signified by that, what we call a climax bar, but we know since it's at the beginning of a move, it's really the kickoff of a new move. And then how do we end it? We end it on a weak climax, followed by a churn bar, which is like a little doji there. On bearish divergence in the momentum, volume divergence in the relative volume, and then this thing comes on down hard and fast after that. And what is it? It's at the top of the area. So we've got trend line here to trend line there, and that gives us the high right here. Does everybody understand what I'm showing here, what's going on? This is the application on a tick chart. Okay, I've connected from the low here to the low here, back to this high. That gives us the high right here perfectly. Let's look at the next slide. Look at that. We've got the volume divergence right there. We've got the spike in the volume. We've come up, we've hit the area. Look at this beautiful trend channel here. We can't quite make it to the top because we've got what? Bearish divergence. Now all that happens in real time. And how do we end the move to the high? On a climax bar, a buying climax. And then what? We get the signal of volume divergence, boom, and it comes straight down. Another good signal, another volume divergence. Spike in the volume, ends on a churn bar. This move ends on a major spike, weak churn bar, pulls back up, ends on another weak churn bar, which is a minor spike, volume divergence, bearish divergence, boom, sell that and it goes straight down. This is where we come into the multiple time frame stuff, and I've only got about 4 minutes left, you guys, so we're going to really get in depth into this on Sunday. and you're going to learn a lot on Sunday. We're going to take this to the live charts, and I'll show you my live examples of all the different trades that I've taken. But this is what I'm looking for. This is a 30-minute chart. You see this? I connect from low to find this high. Let me just show you briefly how that works in real time, because I haven't shown you that yet. So I've got my trusty, whoops, bear with me. I've got my trusty Toolbar Pro right here, as you can see. So these are the automated trend channels. You see that? Watch that. So I've got 3 different types here. I can do just the automated trend channel, high to find the next low, or I can do with the median lines. You see that? Or I can do with the median lines and the ABCD projection. And there's the ABCD projection. This is the trajectory of the previous move down. Here's the previous move. Here is the trajectory of that move extended down. There's the 138.2 fib. There's the 100% fib. All of these lines have alerts and emails built in. Incredibly complex programming. There's so much more to this thing. I'll get into the details. You can add alerts to any user-defined line. Let's just go over one example here. This is a weekly chart of gold. Let's delete everything off here. We go from, whoops, we go from low to find the next high. Look at that. We find the high here, find the line here and here and here. We'll go into all of these different examples on Sunday, but it's quite uncanny how everything comes together with this market geometry. Look at this, from high to high to find the next low. This is the area we're looking at right here. It pulls back to the area on bearish divergence, which is also volume divergence on the 240 minute. That was a daily chart we were just looking at. Pulls back to the area right here. Whoops, I just moved that line. You see that when you get an alert, the chart will come into focus as well. You can turn that on or off. So if you have one workspace with 100 charts, you can do all of your analysis, and whenever you have something come up, an alert's fired, that chart will come into focus. Here we have the divergence. We have multiple time frame divergence there at this area, and then it rolls over on volume divergence. All right, I'm going to end it this. Yana, would you put in the special offer link, please? We'll go over the different details of these trades, you guys, on Sunday. I need to end it here so the next presenter can get ready. Let me do this. I'll show you briefly what's going on here, but we'll come back on Sunday. Here's the link for the meeting on Sunday, right here. If you guys are watching the recording and you can't see the link in the chat box, there's the link. Here is the special offer page. And I have it set up for, if you don't already own Bloodhound, then you can get everything together with Bloodhound here. If you do already own Bloodhound, then you can get everything together with those Bloodhound template, volume divergence templates. If you don't want the Bloodhound or the volume divergence templates, you can get the whole entire suite of indicators here. All right, and I'll go over the details of that on Sunday. So thank you guys for paying attention. If you have any specific questions for me, you can email me to support@tradetheplan.com. All right, thanks everyone. And thanks you guys at Trading Pub and NinjaTrader and Shark Indicators. Have a great day.
Well, thank you, Daniel, for that very thorough presentation on the tools and indicators that you've developed for trading the markets. And I can easily see